Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving right into. It was a losing week on Wall Street as headlines from President Trump sparked volatility and investor uncertainty on Friday, but chip stocks showing no signs. The AI boom is slowing down. We're looking at the top moves of the day. And the future of American icon Ford. It's been a bumpy ride, we know, for the automaker, and we're going to hear from the company's executive chairman. That is straight ahead. Well, 2025 was a record year for ETFs with $1.5 trillion in net inflows. That was a 32% jump from the year prior, according to FactSet. Can that momentum continue in 2026? Joining me now on this, we got Marissa Ansel, Goldman Sachs Asset Management Head of ETF Investment Strategy. Marissa, it is great to see you. So let's actually take a beat there on 2025 to start, because you say ETFs here, Marissa. You point out they had a record-breaking year. Why? What explains that? What changed in terms of flows, launches? What explains it?
Everything changed, and everything explains it, actually, because as you said, the ETF industry had a record-breaking year in 2025 in terms of assets, flows, launches, and volumes. So really, we've reached new milestones across all four of those metrics, and I think the trend is continuing into 2026.
You also point out here, I thought this was active ETFs. Now that's still a small share of total ETF assets, but you say you're punching well above their weight, you say, in terms of flows and launches. Walk me through what explains those trends.
Yeah, so that's a really interesting one. I think one of the key observations when we look at the flow numbers and kind of the activity within ETFs last year was, as you said, active ETFs punching above their weight. And what I mean by that is, active ETFs by the end of the year constituted about 11% of overall ETF assets. Yet last year, for the full calendar year, they represented 32% of ETF flows, and actually they represented 86% of new launches. So again, we can really see kind of where the puck is going in terms of trends.
And what about active fixed income ETFs specifically? Why is fixed income, Marissa, so well suited to like active management in an ETF wrapper?
Yeah, that's a great question, Josh, because when we think about the fixed income market as an asset class, because of its scale, the fragmentation, all the structural inefficiencies of fixed income, I think the asset class really lends itself to all the benefits that the ETF wrapper can bring. In other words, the transparency, the liquidity, the ease of trading that the ETF vehicle can bring. And I think one other thing that fixed income really lends itself to is active management. And so kind of, going back to the first point, active ETFs, which of course harness the best of active management capabilities, in other words, individual bond selection with those benefits of the ETF wrapper, that's really where we're seeing kind of flows going.
Let's talk about derivative income ETFs. That, you say, that was actually the biggest flow winner in 25. What's driving that? What do you see this year?
Yeah, so we have seen a huge demand from our clients for derivative income ETFs. And as you said, last year, derivative income ETFs as a category was the #1 flow gainer within active ETFs. They attracted inflows of about $58 billion for the year. What we're hearing from our clients is, number one, they really want income. So they value kind of taking that cash flow up front rather than being entirely dependent on potential capital appreciation. They want to stay invested. They want to keep their exposure to the equity market, but they want to kind of take those the cash flows in the form of present income. And I think our premium income ETFs, GPIX, GPIQ, they have been so popular with our clients for two reasons. Number one, because they offer a consistent high level of income. So we seek to distribute 8.5% for GPIX, 10.5% for GPIQ annualized, paid out monthly. And number two, they actually use an active dynamic call writing strategy.
What does that mean, Marissa, in plain English, if possible?
Yeah, great question. So GPIX gives exposure to the S&P 500, GPIQ to the Nasdaq 100. So you're getting kind of equity exposure. And then each one has an actively managed call writing strategy on top. So what we do is we sell call options on each of those equity markets in exchange for premium income. And that premium income that we generate, we pay out to our investors. And what our investors love is the fact that our call writing strategy is dynamic. And so we don't cover the whole portfolio. We only cover what we need to generate those target distribution yields. And what that means is that we leave more of our portfolios exposed to the equity market. And so historically, that's allowed us to give good capital appreciation, really grow our NAV over time, and grow the dollar distributions that we're paying out to our investors.
Finally, Marissa, I know Goldman recently agreed to acquire Innovator Capital Management.
We did.
What does that mean for the broader ETF strategy? What gaps does that fill in?
Yeah, so we, as you said, we have agreed to acquire Innovator Capital Management. They are the pioneer in the defined outcome ETF space. We're super excited about the agreement. And we really see a lot of growth in the defined outcome space. That was another top flow gainer last year. The actual category has grown at 66% on a compound annual growth rate basis since 2020. And we see that growth continue because what we hear from our clients is investors really want to have those predefined outcomes, and they want to target specific risk levels in their portfolios. And so, again, very excited about that acquisition there.
Marissa, great to see you, especially on set. Thank you.
Thanks for having me.
Stick around. We're looking at the takeaways of the trading day that's coming up next. Stocks end a volatile week lower amid growing uncertainty over the next Fed chair. Here with the trading day takeaways, Yahoo Finance's Jared Blikre. Jared.
Thank you. Let's talk about the technicals and what the markets did. The Fed chair, well, we don't know what's going to happen with that, but smaller stocks, they did rip. And so let's take a look. It wasn't the Dow. I'm going to skip right on down to the Russell 2000 to show you what happened this week. Russell 2000, the small cap index with about 2,000 stocks in it, was up 2%. And the Russell has been outperforming since December for the most part. And that's what it tends to do. There is an historical analog or seasonality pattern that small caps outperform large into February. So that is not a surprise, but we are seeing it in spades this week. And we'll get to some of the larger ones in a second. But here's the S&P 600, different mix of small cap stocks. They have to be profitable. The Russell 2000 also includes unprofitable stocks. But the S&P 600 up about 1.7% there. And the S&P 400, which tracks mid-cap stocks. And that's kind of the sweet spot between the small and the large. They have to have proven themselves. Haven't gotten quite up to the majors yet, although some of them have gotten to the majors and they've fallen back into the mid-caps. But that's an interesting segment that I don't really talk about that much. Nevertheless, mid-caps up about 1.3%. And I'd be remiss if I didn't talk about the micro-caps. Here we got the CRSP US Microcap Index up 2.3%. So greater than all of these that we were talking about, greater than the Russell 2000. And I think I mentioned the other day, there's an iShares Microcap ETF, IWC. It is now up 11 straight days. So it tied the record 10 that went all the way back to 2017. Now you got to go all the way back to 2016 to find a similar record. Suffice to say, we have not seen a market like this in about a decade. So let me see. I think that does it for the small guys.
So that's the small caps.
Yes.
What about the larger ones?
Let's do that. Larger stocks a bit defensive here. And for this, I'm going to go over the Dow, the Nasdaq, and the S&P real quickly just to show you that they were in the red for the week. So the Dow just barely negative 0.3%, the Nasdaq 0.2%, and the S&P 500 kind of in the middle there. All of them less than 1%. So not the biggest deal. And what matters for the S&P 500 is what happens throughout all of January. If you're positive throughout all of January, that portends a positive rest of the year. But my point of this little segment is I want to show you what's happening with the large cap sectors, because this is year to date. Let me dial this down to a 5-day. Here we go. This week, real estate was in the top spot. That's up 4%, followed by Staples, 3.6%. And I mentioned a few days ago, Staples had their best run in several years, actually going back to the early pandemic in April or May of 2020. So Staples number 2. Then we got industrials. That's not a defensive sector, but nevertheless, that is interesting that it's in the mix. And then energy and utilities, both of those arguably defensive. Energy, why is it defensive? Well, I don't think we got time to get into that. But so 4 of these top 5 are defensive sectors. Most of the other ones in the red here. And what's ominous to me is financials. We just kicked off earnings this week. It was the big banks, and that did not go well. So hopefully tech turns around, because tech, I'm going to show you a chart here. XL, can you hit XLK there?
I can.
Thank you. Let's put a 1 year on there. And I was looking at this earlier. Actually, let's dial this down to 3 months. It's just been going sideways for the last 3 months. So basically done nothing. It's time for tech to step up again. That's what this bull market was based on. We've seen sector rotation, but I really want to see tech outperform in this earnings cycle here.
Anything else that was up on your radar?
Oh, got a couple things for you, Josh.
Okay.
Silver and chips. So I mentioned that that the tech trade was kind of going sideways. That's not true for the chip trade necessarily, because chips have been hitting record highs as silver has. And by the way, silver is a component in chips. So here's a 5-day look at semiconductors, and you can see a lot of outperformers here. Let me sort by performance. You can see AMD up 14%, KLA up 12%, Western Digital 10, SanDisk another 10, and the year to date, these guys have been flying high. We've got some really big, there's SanDisk up 74, 75%, Applied Digital up 52%, and I'd be remiss if I didn't show you what silver did this week. Upper left, silver is up 6%. Can you hit that for me? Thank you. And I'm going to dial this to a 1-year chart, and you can see 184%. And as I was talking about a few days ago, we were talking with Kenny Glick on the Stocks in Translation podcast. He's been collecting silver his whole life. He said, I've been waiting my whole life for this one moment, and it's happening right now in silver. So we'll have to see. The longer the base, the higher in space. This is a 40-year base. Got a lot of space to go, maybe.
All right. Thank you, buddy.
you, sir.
Appreciate it. Stick around. Conversation with Ford Executive Chairman Bill Ford. That's coming up next. Ford just launched its racing season, highlighting its big comeback to Formula One. Company's executive chairman, Bill Ford, spoke to Yahoo Finance senior autos reporter Pras Subramanian about this big move, the EV landscape, and the company's legacy as an American business.
123 years, we're still a family business. I'm only the 4th family member to be at the top of the company. I've had every title. I've been president, I've been CEO, I've been chairman, I've been COO, and I love it. And now I've got my next generation coming through. I've got 3 of my kids working there. One's actually right over there. He's in helping run Ford Racing. And I don't know if you saw this, but Time Magazine last week published the most, they interviewed 10,000 people, said, who's the most iconic American company? It wasn't Starbucks, wasn't McDonald's, it wasn't Disney, it was Ford. It wasn't Apple, it was Ford. And you know, it's to your point, yeah, we're a great American company, and very proud of that.
You know, your son Will over there doing the racing stuff, right over there. And also you're talking about American industries, American countries, companies, Carhartt, big deal there for you guys, both Detroit, both Michigan, born and bred. You know, it's so important to build in America. And I know for you guys, there's 80%, I think, is UAW workforce. How do you keep building more with hiring more U.S. workers? Is that the future of Ford?
Yeah, we're adding more workers this week, and we're growing as a company. Our market share is growing, and yeah, it's great, and it's something I'm very proud of. And even when before anybody had heard of tariffs or anything, our competitors were moving their production elsewhere. But to me, it was important that we remain centered here in America. And so we paid a penalty for that. It cost us more. But in the end, it was the right thing to do, I felt, because you don't turn your back on America. And we build the most vehicles here. We employ the most Americans of any company. And I'm very proud of that.
How do you then kind of keep manufacturing going in America beyond Ford,
Well, no, it's really important. And I think there was a whole series of politicians who just didn't care about it. And we were really in danger of losing our industrial base. Fortunately, the last few years, both Republicans and Democrats have realized, wait, it is important. And it was interesting. One of the aha moments, I think, was during COVID when we took respirators and ventilators that other companies could only make, a few a month, and we could make 1,000 a month. And I think that, people in government woke up and said, my goodness, we can't lose this. And of course, we were the arsenal of democracy in two world wars, and and the country needs a strong manufacturing base.
Is that sort of how, Ford had a big EV pivot here, right? From pure EVs to more electrical powertrains, beyond EVs, hybrids, stuff like that, E-revs.
E-revs, yep.
Is that sort of the flexibility that Ford has as a manufacturer?
Yeah, it is. I mean, part of it is we're a global company and we can, draw technology from, different parts of the world. I think it is important. I mean, what happened with the EVs was the regulations got out ahead of the customer. And there was a mismatch, which is never good, between where the regulations were pushing us and where the customer was saying they wanted to go. We're much more aligned now, and I think it's the right place to be.
And we have only a short amount of time with you, but I want to talk about racing. And look, we're here for the big night. F1 with Ford, a big partnership starting there with Red Bull. What's your sort of outlook on that? Where do you want to be in like 5 seasons?
I want to win. I mean, that's why we race. Look, one of the highlights of my life was in 2016. We'd been gone from Le Mans for 50 years. We developed a supercar that nobody knew about. There were only 3 people who had keys to the room. It was kept completely quiet. We showed up at Le Mans and we took on Ferrari again after 50 years, and we won again. And to me, that was such a highlight, not only winning, but all the work that went into that, all the engineering people that poured their heart and souls into it. That's the cool thing about racing is, what you see on the racetrack is amazing. But then all the tech transfer that comes from that to the rest of your products is really great. I mean, for instance, right now, we're racing in Dakar, and I think they got 2 stages to go still. It is the ultimate torture test for our Raptor vehicles, and we'll take those learnings back and make the Raptors even stronger.
So real quick, you mentioned the Ford GT winning that 2016 Raptor, of course. I might know the answer to this question. What is your favorite Ford car of all time?
Ooh, it's like asking who's your favorite child. So it's got to be a Mustang of some sort. I've got so many of them, and they're all serial number ones. And in fact, I just took one on Jay Leno's show. My favorite car that I have, and I can answer that. It's very sentimental to me. My dad drove the pace car at Indy in 1968 in a Torino convertible.
Really?
And I was 11 years old, and I did all the practice laps with him. And I remember A.J. Foyt used to put me on the back of his motorcycle at the Speedway Motel at nights, and we'd do wheelies. And as an 11-year-old, I thought that was so cool. And anyway, my dad drove that car during the race, and then my dad passed away, and I'd been looking for that car for many, many years. We finally found it rotting in a field in Iowa. I've had it completely restored, and I drive it now. So for me, that's probably my favorite car.
Maybe we can see that doing a pace lap at the next F1 race.
Exactly.
Bill, thank you so much.
No,
really
Pross,
appreciate
great to see you. Thank you so much. Thanks.
That's a wrap on today's Ask for a Trend. A reminder, the market is closed Monday, so we'll see you back here on Tuesday. Have a great weekend.